Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Binns
and Ernest. You ready? Let's dive in. Welcome to Samir Kaji. If you follow the LPGP network at all, you have probably read or heard plenty from him. Co-founder and CEO of Allocate. We're so thrilled to have you on the show. Thank you.
Thanks for having me.
Prior to founding Allocate, Samir has 20 years of experience in venture banking, supporting over 700 different VC and PE firms. He's a Kaufman Fellow, like my co-host. And today we're going to talk about this ongoing exploration of wealth managers and RIAs into venture as an asset class, how they're doing it, and what's been working for them thanks to Allocate. You began your career at Silicon Valley Bank and First Republic Bank. Were there lessons learned from those experiences that sort of started percolating the idea for Allocate?
Yeah, there's a lot of lessons, and I'll give a little bit about my background because it does speak to why I created Allocate with my co-founder, Hannah, and then ultimately what we're looking to do in terms of kind of bridging between the world of private funds and the world of private wealth. So my dad was actually a first-generation immigrant, came over from India, ultimately got a degree from Old Dominion as a civil engineer, and then realized about 4 years later he wanted to do something that was more entrepreneurial. In his mind, where he saw opportunity was commercial real estate. And this was mid-'70s. No one was really giving him an opportunity. And then finally there was a guy named Jack Bailey that said, hey, I like the way you think. You're a hustler. You're obviously very persistent. Why don't I give you the opportunity to join me, and I'll see what you do. And I really like that. I really like the story because it speaks to, giving people opportunities that historically have never had opportunities to succeed in certain areas. And so my dad ultimately started his own real estate business. And so I had this great fortune of working, alongside my father as a teenager, just going on his trips. And he bought a lot of property in Dallas, Fort Worth. And so we were commuting there, and I'd see the guy wake up at 7 a.m., go to sleep at 10, and the same level of energy at 10 p.m. that he did at 7 a.m. And it really kind of stood out, like, I want to either be an entrepreneur or work with entrepreneurs. And so when I graduated in the late 90s, I had the opportunity to join my dad's business. But at the time, I really wanted to chart my own path, and had this opportunity pop up on my job board for Silicon Valley Bank. This is 99. At that point, this was the height of the tech bubble. Companies were going public it seemed like 18 months after starting. And I said, this is an opportunity for me to work with these really interesting companies that were kind of reshaping the world with technology. And the internet was the thing that was top of mind. So I joined SVB in September 99, not knowing that 7 months later that the bubble would burst and we'd go into the dot-com bubble bursting completely. And there was 2 years of like, what did I get myself into? But during the time at SVB, I got to work with some great entrepreneurs. I worked with folks like Roku and LinkedIn when they first started. And one of the most fascinating things is when you get to work with people that start things and you work with them at the early stages and be along the journey, you kind of see how they change. You see how they can impact so many different things. And I really enjoyed that up until 2008 when the next crises happened. It was global financial crisis. And I actually kind of made a career change within the organization. I moved to the private fund group. So that was doing the banking for the venture funds, the private equity funds, and also investing in the funds themselves. And at that time, you both know this really well, is that the technology industry had changed because of AWS. It made starting a company so much cheaper. That created this Cambrian explosion of startups, which then made it possible for the institutionalization of the seed market. Back then, we called them super angels. Yeah. And it was people like Mike Maples and Aydin Senkat and Jeff Clavier. And I remember in 2010, I'm like, I think this is the future, that venture capital is going to institutionalize, it's going to fragment, it's going to go the way of private equity, where we're going to see different type of products. And I really liked working with the emerging managers, primarily because they felt like they were entrepreneurs that happened to write checks versus code. And so I made my way from there to First Republic in 2012 to really start a group focused on banking venture firms, with the focus being emerging managers. Our first two clients actually were a firm called Formation 8, which now is is broken into a few pieces, 8VC being the biggest. And then the second was Forerunner, which is a woman named Kirsten Green who started the firm in 2012. And during that time, our focus was how do we help these emerging managers get off the ground? And the area that we thought we could add the most value, and it wasn't really banking, it was around this focus of capital formation. The people that are investing in these firms tend to be family offices, individuals. How do we get them in front of these people consistently? And at the same time, help, some of the family offices we were working with access, interesting opportunities within the, emerging manager space. It was 8 years there. We built a group of over 50 people, ended up working with about 700 different VC firms. And during that time, we saw our family office deploy about $1 billion into these different venture firms. And so it became very clear that as the world continued to shift, investors are moving more of their capital away from what we call 60-40 portfolios, meaning that 60% public equities, 40% fixed income bonds, to things like alternative assets, venture being one of the alternative assets. So at First Republic, it was great because we had a private bank, we had a wealth management firm, we had a commercial bank. Within the wealth management firm, we were one of the most active in bringing alternatives to our clients. So much so that over time we realized we have to expand the aperture to include things like growth equity and venture capital, which we did in 2019. But the same thing kept coming up, which is for an individual investor to invest, you have to be able to not just put money in alternative assets, but build the right type of portfolio. So portfolio construction, you have to get into the right assets. The dispersion of return, as you know, in venture is Grand Canyon size. In fact, top decile is about 30% higher in terms of net IRR than bottom decile. Yeah. So you really have to be in the best. So how do you remove these barriers for people to be able to not only invest in alternative assets, but to do it in a way that's highly effective and highly efficient? And that was the idea behind, let's start a company that really builds an end-to-end sort of tool set for LPs, being family offices, individuals, and wealth advisors, to be able to build the very best portfolios with the least amount of time. And that's kind of what we've done. But a lot of it was shaped by the 25-year learnings at the two organizations I was with.
Samir, that's really helpful, especially your perspective on seeing so many shifts in the market. So starting your career in 99, then 08 till now, as you're developing this thesis for Allocate, how are the experiences of the previous kind of downturns within tech influencing kind of your kind of theory of change when it comes to Allocate being a real need in the market?
Yeah, and what we do is venture's one segment of what we do. We certainly do private equity and things like that. But let's maybe go to venture as an asset category, first of all. Number one, it's changed. 25 years ago, it was like you only needed to identify the top 10 to 15 venture firms and try to get in. And that was because everyone was effectively doing the same thing. Today, venture is very different. An emerging manager cannot be compared to a large cap, multi-product platform like, and you could pick your firm, Sequoia, Andreessen, Lightspeed, very different type of products. And so when we look at venture, we define venture very differently. It's anything from pre-seed, 2 people in a garage, all the way to essentially pre-IPO. And that's kind of how people bucket venture. Within that, there's different classes, which we can go into later. But one of the things that we fundamentally have looked at with venture and cycles is venture is a cyclical business. There are going to be long periods of risk on, followed by sometimes very rapid periods of risk off. You saw that in the 90s when the internet, if you look at the amount of capital that was raised by venture funds in 99, it was probably 10 times as much as you probably needed at that time, given where the infrastructure where it was. And then risk came off in 2000, 2001, and then it slowly built up until 2008 when, the market shifted, and in about 2 years everyone went risk off, not because of tech or venture, but because of the broader economy. Yeah. And then we went on this long risk on period from roughly 2011, maybe 2012, all the way to end of 21. Small blip, when it came to COVID. There was like 3 or 4 months where no one was doing anything, and people thought the sky was falling. And then you had rates go down, and you had so much liquidity pumped into the system. So as an investor, we always say that you're always going to deal with cycles. And from an investing standpoint, you have to invest through cycles, because you don't want to be at a point where you're only going in when times are the hottest, when marks are the most expensive, and when you lose all sobriety, meaning that there's a lot of things that get funded that shouldn't. And so what happened post 2021 is very similar to what we saw in 2009 and 2010. People go risk off. Maybe there's a liquidity issue. There's a ton of things that get people not to want to invest in long-term and liquid assets. The problem is these periods have historically been better periods to invest because you're starting a new curve.
Yeah.
And what we look for is two things. Number one, as sobriety come back in the market, number one, which I think it has, generally speaking, we can debate. There's probably some pockets that doesn't feel like there's sobriety, especially with large LLMs and AI. But overall, it is much tougher to raise capital today for both funds and for companies, no doubt about it. The second thing we look at is within venture, is there a new technology paradigm starting? And we saw this, the internet was there, it was real. But the reason companies like Webvan didn't work, it was just too early. The infrastructure wasn't there. The cost didn't make sense. Right now, artificial intelligence is the next paradigm. Now, these paradigms tend to be overrated in the very short term. That's why you have so much money, and underrated in the long term. And so if you are a long-term investor in the asset class, these are the times you typically do live for, because you have this intersection of a new paradigm coupled with sobriety coming back to what I would consider 90% of the market. And so I look at this cycle, and things don't always perfectly repeat itself, but there's enough rhyming characteristics where it's not too far of a path to visualize that what we may see over the next 10 years is a similar type of output that we saw post 2008 and certainly post 2001 and 2.
You all put out awesome market research. Is there anything else that you're sort of seeing in your crystal ball for the next 2025 and even beyond?
Yeah, so within venture in particular, so one of the things that I mentioned earlier is like companies used to go public really quickly, right? So the time from starting to an exit used to be on average 4 to 5 years. And people sometimes forget Amazon was founded in 95. It went public in 97 with trailing 12-month revenues less than $20 million a year.
Wow.
You would never see that type of company go public. In fact, the market cap of the company was sub 400 million. I think it was 385 million when it went public.
Wow.
OpenAI just raised at $157 billion valuation in the private markets. The problem is, because there's so much capital now in the private markets, these companies don't have to seek a organic way to exit quickly, right? You don't have to go IPO, and the bar for IPO is much higher than it ever was. And even the M&A market, probably to a certain degree, is going to be impacted by regulatory and the fact if you have capital market that will continue to fund you, you don't really need to sell. You can continue to build and build and build. For individual investors, the characteristics actually impact them more than the big institutions. Big institutions, you invest in venture, number one, because you do have access to great firms. You also have less of a liquidity need. It's more venture provides you diversification across your assets, lowers your volatility. But as an individual, if now companies are staying private for 12 years, 13, 14, 15 years, well, my illiquidity premium has to go up. I can't take a 2.5x if you're going to take 15 years to get my money back. So one of the big trend lines we're seeing is, and we saw this in private equity, is that venture investors are figuring out how to generate liquidity in non-organic ways. Organic is like M&A or IPO. We saw secondary tenders, selling in a secondary. I'd say that's semi-organic. But more recently, we've seen things like strip sales. We've seen even continuation funds by bigger firms to generate liquidity back to their LPs. And I think that's something that needs to be solved. Illiquidity is generally, I think, a feature, but there's limits to when it starts becoming a bug. And so I think over the next 5 years, 10 years, we're going to see much more of a secondary opportunity for generating liquidity. I think they're going to be more GP-driven liquidity, not just LP. And those are the things we're following really closely right now.
What do you think as far as with the movement of more individual investors looking to go into these private asset classes, in particular venture, where you said like who you pick as a manager is the most important decision?
Yeah.
What are some misconceptions it could do with today's market or like even just long term?
Yeah, I think there's a lot of misconceptions, unfortunately, and some of this is because venture in itself is a very idiosyncratic, weird asset class. It doesn't behave like anything else. You have this thing called the power law, which, few companies drive so much of the performance, and then beyond that, venture, the way it operates in terms of within a portfolio, you may have 2 or 3 companies in a portfolio that actually determine how successful a fund is going to be, and you don't know until maybe 5 to 6 years later. So it's even hard to make a decision based on track record, because if you're looking at an emerging manager, there's no track record, or there's little. Established managers' track record might be too old to matter, or it's too new to matter, and the business model might have changed over time, where now they're raising $3 billion funds, not $500 million funds. But I think some of the misconceptions are the following. So number one is venture can be timed. It cannot be timed. I have no clue which vintage years are going to be the best. All I look at is characteristics and say, do I believe that there's a list of ingredients there that could help me be more successful in a given year? The second, I think, is it's a one-size-fits-all investing, which is venture is definitely not a monolithic asset class. So if you look at the number of U.S. venture investors, depending on how you count it, it's between 3,000 and 4,000. So between 3,000 and 4,000, the fat tail is what we'd consider micro VCs, sub 150 million. That's the vast majority by number, small by AUM. Within that, there's the highest degree of volatility in terms of returns. In fact, the standard deviation of returns we found to be 2.9x higher than the big funds. So again, that's where you can shoot for alpha, but you have to get into the right one. So it's not just because I'm a small fund, I'm going to succeed. There's a lot of survivorship bias, unfortunately, in the numbers sometimes people present. So again, it's not one size fits all. You really have to determine like what your risk return appetite is. And then I think the other thing that often comes up is that looking at venture as a asset category that doesn't require some level of diversification. I think you do really need diversification. Some people I've seen invest in like 2 VC funds a year. And candidly, I think that is not a way to get enough coverage to be able to get those power law outliers. And so for the vast majority of people, actually, they should probably look at fund of funds unless they can, designate enough time to build the relationships, build the diligence capabilities, and then have a capital foundation to be able to invest in a lot of one-off opportunities. So these things come up a lot. Liquidity comes up a lot. It's like, well, it's going to take me 10 years to get my money back. Not quite true, because of the drawdown schedules are typically 4 to 6 years, and then distributions start year 7. But this is an asset class that needs a lot more education to get right, because at the end of the day, the reason we launched something called Allocate Institute is because we saw so many people with misconceptions of big fund bad, small fund good, and it just became a little bit paint by numbers. And there's so much nuance that goes into identifying not only how you build a portfolio, but how do you even pick a good fund manager when you're meeting with all these people. And venture investors are very good at sales. They're great at telling a good story. It feels great, but then if you've been like myself and looked through maybe 3,000 decks, everything starts to look the same after a while. And so what actually matters is how do you think about a firm in terms of its ability to be advantaged on a go-forward basis. And so these are all the little things that education really needs to be in place for individuals to be successful in the asset category.
Oh, well, I had a follow-up that I just want to ask you, Samir, on that subject of like not having diversification. I've also noticed a growth in just the desire to do more directs from experienced and non-experienced allocators. What do you think that's about, and what do you advise people on?
the reality for the vast majority of people, if you're not doing this full time, it's hard to make the case that you are going to outperform somebody that does do it full time, that is actually of high quality. And so adverse selection is, rampant. And don't get it wrong, there's some great family offices that are very, very good at doing directs. But I did see a lot of people learning and then doing the co-invest along with the firms they've invested with who, tend to have less adverse selection, because if I'm an LP, I can, they probably want me as an LP going forward. And part of the reason was people wanted to save fees, and generally speaking, when people are successful in other parts of their world and their lives, they feel like it can carry over to this industry, which
Sure.
Candidly, a lot of things did work during the 2010s because everything was up and to the right, and so you start to get this false level of confidence because your companies were marked up, and all of a sudden you feel like I'm really good at this. And then 2022 and 23 come around and everything goes, hopefully not to zero, but in many cases it went to zero. And then many of those families then come to the conclusion that venture is a bad asset category versus I probably prosecuted the strategy the opposite way. So I always think about crawl, walk, run. Crawl, walk, run means if this is not what you do and you haven't built an entire team around it, you usually start with something that would be a gateway, which would be like a fund of funds. And then you can start picking individual funds and do co-investments. And then if you find you're really good at that and you really enjoy and you can dedicate the time, then you can start sourcing your own direct investments. But people started, unfortunately, the other way around, and it hasn't worked out for the vast majority of them.
Curious to your hypothesis on what the high net worth, family office, RIA community would want to look at, or the way they'd like to approach venture as an asset class when you first got started with Allocate versus what you're sort of productizing for them today. Like what have you learned is actually a much more, maybe it's just from a ops standpoint, what actually really works for them and their clients?
Yeah, there's a couple things that usually come up, and this is maybe not just venture, but it's all of private assets. The reason a lot of wealth advisors have gone down the path of adding alternatives is, number one, it's a highly competitive market. There's about 18,000 wealth advisory firms in the U.S. We're also going through the biggest generational wealth transfer of all time, where money is being inherited by the Gen X millennial from the baby boomers. This next generation definitely is inclining more toward alternative assets as part of the portfolio. Right now, it's still a small amount, though. So if you look at all of the assets managed by independent wealth advisors, less than 10%, and it's generally less than 5% are in alternative assets, less than 1% in venture. And the reasons are hard to understand, hard to access, it's the illiquidity, all these things. So what we found for a lot of the wealth advisors is if we are going to implement these type of strategies like venture, number one, you have to de-risk it so that I can feel comfortable giving it to my clients. Number two, operationally, it needs to be easy for my clients to be able to invest and track their investments. And for those that are listening that have done a lot of individual private investments in funds, sometimes you have to log in 30 different portals to get your documents and then trying to extract it. It's people use the most successful software of all time, Excel, to get all the information. It's super manual. So what we kind of realized over time, it's not just access to opportunities that are highly vetted, but it's also creating the infrastructure that makes it easy for people to sign up, like digital subdocs, KYC, AML, and then being able to track their entire portfolio in one place without the manual approach of having to log into a different portal. So what we found is it's not just a point solution, but it has to be holistic in nature to enable wealth advisors or families to be able to provide these assets at scale. And so that's a lot of what we've focused on in the last year and a half, is just really building those software tools that sit on top of our originations, which today the originations are venture and private equity, which we have a team that goes out and finds the managers, gets access, and then miniaturizes what people have to invest. So the average investment can be $100,000 going into funds that historically have had minimums 20 or 30 million. And even then, that's not an immediate sort of pathway to get in, because you still have to convince the these high quality GPs to take your money.
I'm curious if any of the GPs who gave you allocation in the past year or two, what your strategy is to continue to have space.
I think the reasoning is, number one, I think people realize a couple things are happening. So number one, there's not a lot of new institutions forming every single day. How many new pensions, how many new foundations, how many new endowments can there be? And those groups historically have been very heavy in investing in privates. And so the price of admission for you to get money from them and them to add a net new name is pretty high. And so as you think about diversifying your LP base, more and more people are figuring out that accessing the wealth channel, but doing it efficiently is really important. This is why Blackstone and the Apollo and Carlyle have so many people dedicated to covering the wealth channel. If you're a venture firm, you may have 3, 2, 1 IR people. How are you going to talk to, let's say, 150, 250, 500 RAs out there? There's just not enough time in the day to be able to manage that, let alone administer all those small checks. However, if you can get, let's say, large amounts of capital, de-risk yourself by not just having one type of LP, in the long term, capital formation is going to be more efficient, it's going to be more effective, and what we see in the next 5 to 7 years is trillions of dollars are going to be invested from the wealth sector into privates. Today, private AUM is over 13 trillion, expected to grow to 25 trillion. Well, where's that growth going to come from the capital provider standpoint? Some will come from institutions. That might be 70, 80% of the capital, but it's not enough to sustain the growth of the market. And so that's why we see these entry points for now more people wanting to access the wealth sector, but they work with groups like ourselves because it acts as a single plugin for them.
Now we're going to take a quick break to speak with our sponsor. So today we have the pleasure of speaking with Nico Toro. Nico is the head of Latin America at Silicon Valley Bank. He brings a wealth of experience in venture capital and the startup ecosystem across the LATAM region. Nico, thanks for joining us today.
It's a pleasure to be here.
So for our audience that may not be familiar with the kind of like nuances of what's going on in LATAM innovation ecosystems, what's been going on in the last 5 years? Is it similarly kind of like followed what's been going on in the US and Western Europe?
Yeah, it's mirrored a lot. So the LATAM ecosystem has matured significantly by its growing regional entrepreneurship, the increased international investor interest, and it's a very supportive regulatory ecosystem, and also in terms of accelerators and organizations like Endeavor, like SVB, and others that are supporting the ecosystem. So yes, it's mirrored the ups and downs of the US market, but it's grown incredibly, especially the past few years. And yeah.
With a global organization like SVB, the thing that comes to my mind is you all provide customization to any market and any customer that you interact with. I would think that would be even more difficult in like LATAM, where people, the US perspective is like, oh, okay, one size fits all, there's similar products for all. But I've had portfolio companies of the past try to, build and expand within LATAM, and having that approach of one size fits all usually leaves them not gaining market share. So I'm curious on like from the different countries that you guys have a presence in, how are you able to understand the different nuances of every market?
That's a great question. So I think that, to be honest, there's several LATAMs. So one LATAM is Brazil.
Yep.
It's the biggest market. It brings in the highest percentage of VC funding, carries the highest percentage of unicorns. That in itself, it's its own market, its own regulatory system, its own risks and opportunities. Then there's Mexico, and maybe I would bundle that with Colombia and Chile, the other ecosystems that are really growing. Maybe Argentina, which is starting to pick back up, and then the rest of LATAM. We're very active in Brazil, Colombia, Mexico, and Chile and Argentina. And yes, we do see a lot of different nuances of the entrepreneurial ecosystem, the regulatory ecosystem, the appetite of investors in each of those markets. And the benefit that we bring is that SBB has been very active for 13 years there. So we have very strong relationships with the legacy funds. So we bank pretty much all the funds in the big funds in all those countries. So we have very strong relationships there. We have very strong relationships with organizations like Endeavor, with other accelerators, 500 startups, etc. So we've been, and through my experience living there for, working in this ecosystem for the last 10 years, we understand with different needs that each of those ecosystems have. For instance, Brazil is very heavy in fintech. How can we help the fintechs there? Mexico right now, very big in the terms of logistics and nearshoring.
Yes.
So how can we serve and support those startups that are in that business?
From your vantage point, what are you seeing the needs of, whether it's LPs looking to invest in those venture funds in those countries, or the actual kind of venture funds that are local in those countries? What are the needs that they need for this next decade?
So we bank a lot of, so what we do in startup banking and what I do is I bank the startups,
Yeah.
the VCs, and the LPs.
Yeah.
Which is actually, if you ask me, the secret sauce and the magic of SB is that we bank the whole ecosystem.
Yes.
Which makes us an ecosystem builder, a connector. So what I do on a day-to-day basis, I connect LPs to funds that might fit their pieces, and I connect funds with startups that fit their pieces. So in terms of the LPs that you're asking, I see a trend. I'm starting to see more and more interest, or regaining interest of LPs from across the world to go into Latam. There was a scare, last couple of years, as you know, what happened in the US, the same happened in Latam, so people got a little scared. There was a lot of tourist investors that went in with a lot of cash and then left. Now we're seeing, there's a matured ecosystem. They've learned that, there's very well respected and proven track record of funds. The economies are growing. There are strong institutions in these economies. The founders are incredible. Everyone's seen that. And the opportunities to create value, again, we're talking about fintech. So there's a very young and tech-savvy population across the region. There's a lot of opportunities in disrupting legacy banks, and so there's this huge opportunities in fintech. So you have examples like Nubank, like Walla, and then there's also new opportunities with nearshoring here. So LPs are seeing those opportunities, like, we need to be part of this story.
Yeah.
So what we do is we connect them to what are the right funds that are investing in nearshoring in Mexico. What are the right funds that are investing in fintech in developing countries like Chile with Bitcoin, Colombia with Rappi and Rappi Bank, or Nubank in Brazil.
So for a U.S. or outside of LATAM LP, if it's their first time investing in that market, in LATAM market, I'm sure there's a lot of different things to kind of navigate your way through. What are some risks that you, what are some risks that you believe that they should consider when looking into this market and invest, or just things to consider?
So I think the biggest risk of investing in LATAM is that it's still in the early stages of creating a deal-making culture.
Yeah.
So the M&A culture is still very small, but it's growing. I think that's the risk. The second is that there's still a small, very small secondaries and growth capital market. So I think that delays, so the cycles for VC in LATAM have been proven to be a little bit longer. I think the other risk is currency fluctuations
Yes.
and regulations. But I think those things considered the opportunities I heard about, you know.
Yeah.
So when assessing a fund, I would, evaluate all these things.
You mentioned regulation. One question I had was, how do local financial regulations in Latin American countries affect venture capital investments?
So, not surprisingly, the Latin governments are recognized the importance of promoting tech ecosystems.
Yes.
Because they solve a lot of issues, because they attract a lot of capital. So, overall, the regulations are very very supporting. So, and they're very mature now. We have very mature markets like Brazil, like Mexico, like Chile. Chile has a family office industry that's been going on for all decades. They're very mature about creating the right regulations to support them. So I think in terms of those regulations, overall, it's a very welcoming market, which is why we've seen in recent Sequoia, Tiger, and many other larger funds investing in those markets now because it's. But on the other side, this is where SEG plays a huge role. We bank all these startups, we bank all these funds, and they're all part of the. They all make a payment standard. So we bank, the Delaware LLC. So that's where the funds and the LPs have like the trust like a figure. There is an American thing supporting this. So it brings trust, it brings transparency.
Absolutely, and comfort. Samir, you bring up an interesting point of the trend of like a lot of this, the wealth transfer, people leaning towards alternatives. But another thing is going on as well. We're starting to see private equity firms roll up, right? So my question with that kind of consolidation, who's the best position to win? Is it the larger funds, or can kind of like right-sized early stage funds or micro funds get an opportunity to efficiently kind of diversify their LP composition?
So I think it's everybody that can diversify. In fact, the smaller funds tend to actually be more individual focused, especially if they didn't roll out of another shop. So if someone leaves Lightspeed, someone leaves Excel with a pretty good track record, they're going to raise from institutions mainly. And there's going to be a few non-institutions in there that are high quality family offices. Going back to the earlier point, let's just kind of look at venture as an asset category today and maybe provide some of the characteristics. The way we've thought about it internally, there's kind of like three main buckets. There's small cap managers that tend to be, 250 million or less. And I wrote a post about this, but the adage of your fund size is your business model. So under that fund, unless you're doing some growth strategy, typically the exposure that LPs are going to get are seed and Series A. So that's generally speaking where you're going to get higher alpha because one company can return a multiple of the fund. The people that are winners are going to be people that have true, not differentiation, but true advantage differentiation. And, there's not going to be 2,700 winners. I mean, there's going to be a small group. And we're going to see a lot of these folks not raise a fund 2 or fund 3 or fund 4. In fact, the stat is, what percentage of people go from fund 1 to fund 4? I forget the exact number, but it's like 20%, 1 in 5. That's not a lot. So some of that will just kind of go away. But the ones that do succeed are going to outperform every single year, no question about it, from a cash-on-cash standpoint. As you go up market and you go to mid-cap, so there's these mid-cap managers that are not the big platforms. They don't have multiple products. They're not raising billion-dollar funds, but they tend to raise very thematic or sector-focused strategies. I mean, Forerunner is a great example. They just announced their fundraise, which is $500 million, kind of focus on the broad sort of category of commerce and consumer. There are going to be some real winners there, and the exposure you get is kind of C to Series B-ish, really. Now, your return profile slightly goes down because you do have some of the exposure in that B and C, but your volatility goes down too. And so when we underwrite, for example, a seed fund, we're looking at, can we get at least a 3.5x net pretty consistently? And small, that's really hard to get. It's not easy just because you're small. The mid-stage ones, you're kind of getting a 3x. And then when you go to the large platforms, there's a lot of discourse on LinkedIn and Twitter about these big funds are just asset gatherers. They're just playing a very different game. And if you think about private equity, there's the Carlyles and the Blackstones and the BlackRocks and folks like that. Well, the bigger firms are effectively covering everything now from inception to IPO. And so when you typically invest with these larger firms, they have like their early stage fund and they have the growth fund. And so you're kind of getting a blend. And to me, that is what we would consider high quality venture beta, which means unlikely you're going to get a 3 to 5x, but it's also equally unlikely you're going to get less than maybe a 1.5 to 2x. And it's fairly consistent time and time again. And so when you think about who's buying these products, what's the product market fit? So what we find is family office typically gravitate toward the small and mid. RAs typically will gravitate toward the larger and mid cap because it's safer. And the world of wealth advisory is generally the stay rich game. It is not take a bunch of risk and if it doesn't work, it's okay. I mean, most people aren't running their businesses like that. And so as I think about it, if you're a large firm, tapping the wirehouses, the private banks, the wealth advisory, if you can do it efficiently through groups like us, is a great way. For smaller ones, it's really kind of the family office network, which, we see a lot of people wanting to build exposure because they view venture as the area of their portfolio that, number one, they're willing to take some risk if it comes with alpha and it comes with relationships. So that's the other thing. It's hard for somebody to put in $1 million into brand name, firm B over here and even get a call back. I mean, it's just not going to get it. It doesn't move the needle for a $2 billion fund. But you put $1 million into a $30 million emerging manager, you are going to get their time. And so a lot of families and individuals tend to gravitate toward that. So when we work directly with families and individuals, it's more about tailoring their experience toward those EMs. And it's with the RAs, we find it's more kind of the mid and large cap.
No, that makes a lot of sense that each of them has a different risk appetite. And I recall from my days of fundraising from RIAs, they all said, oh, well, we only look at if we were to do it, we would only look at the top brand names. And thanks to you, they can.
I do think, though, in the future, people are going to start to realize that a small part of the portfolio should be, some of these true alpha generators, but you have to get it right. And the problem, and this comes with the institutions too, is picking is really hard. It is really, really difficult to pick emerging managers. And it's really difficult to discern who's really advantaged and why they're advantaged. And, is it sourcing, winning, picking, which should you be indexing on? And we have thousands and thousands and thousands of them. Like even picking 10 might require you to meet 300 to 400 managers, right? So it's a time thing. That's why I also tell people well, maybe what you should do is invest in like an emerging manager fund of funds because it allows you to be able to get enough diversification and it takes away sort of the time issue because to invest successfully in private markets, you have to have access. And it's not access in just the traditional sense of can I get into certain funds? It's access to time, access to knowledge, access to relationships. If you don't have those things, you got to figure out how to hit the easy button because investing shouldn't come at the sacrifice of returns. And a lot of families, what we've seen historically is they'll invest in people they met at the golf course or whatever, and they build a relationship, but unfortunately it comes at the expense of returns because it's not a manager that has some kind of significant advantage. So it is something that we're big believers in. Having covered emerging managers for a long time, I continue to believe it's one of the best places to invest if you get it right. But if you can't get it right, it's a horrible place from a risk, return sort of dynamic.
The numbers you shared on, what percentage of people's private wealth is currently in private. Do you have a sense of sort of net worth where you can actually participate in venture capital in a way that you would recommend, whether that's following kind of some of the models that you're building at Allocate or the endowment model? It's like, can we truly democratize this, or is there really sort of a ceiling in which this becomes smart or idiotic?
It's such a great question. And this may be a strange thing coming from me, given what we do. So the word democratization probably has been overused a little bit, and I think it's more about responsible participation. And what I mean by that is somebody that has, for example, the ability to qualify as an accredited investor on the basis of income alone, right? Because you can do that. I make $200,000 for the last couple of years, and I think I'm going to make that this year. I can be an accredited investor, therefore invest in a lot of the venture firms that are structured to allow accredited investors. The problem is the liquidity premium for me should be pretty high, because if I don't have a lot of capital, I might need to buy a house, or I have medical emergency, or in family, or whatever. Venture is actually not the greatest place because my money is going to be locked up for a while. Better to put it in things like private credit, or even lower middle market private equity to the extent that you can get access to it, because you have a shorter time and it's going to risk adjusted. It might be a better fit for you. And for most of these people, the public markets are a great place. Just put in an index. I think once you get to about 5 to 10 million in investable assets, that's when it becomes a real conversation of using venture as part of your portfolio in a structural way, which is, now I'm going to put 10% of my portfolio into something like venture. And 10% is not a lot either, because if I have $10 million, that's $1 million to put into the asset category, to which I'm not going to do it all in 1 year. I mean, usually you want to build that over 3 to 4 years, so that's $250 a year. And so then how do you build a portfolio with $250 a year that's going to be highly diversified into the right assets? And so generally speaking, people that are less than 5, maybe you do one-off here and there. I have no problem with, you put 20 here, 50 here. But when people go too far over their skis in venture, it can be a highly risky proposition. So I generally would say 5 to 10 million plus is when it becomes like, hey, let's really think about implementing venture structurally and as part of your portfolio construction.
That's really good advice, because I was going to ask who's the ideal type of family office to come to you, and it also made me think of talking to a good friend of Maya's from QED. He was noticing that there is within kind of like a trend, and especially in millennials, of financial nihilism, right? Like not being responsible because things are so democratized, and this is why we've seen the wave of crypto and all those things, and that being a trend you can actually invest on. I love the approach. You said responsible. What else do you want the individual to kind of be thinking about and kind of be prepared before going to talk to Allocate?
So, number one, there's no one size fits all. Everyone's different when it comes to the liquidity requirements, their risk tolerance, their return expectations. I have some families that come to me and say, I'm only going to do venture if I get a 5 to 10x. And I said, well, I just don't think that's realistic. I mean, when you look at the top decile being just a little north of 3, how do you expect to get a 5 to 10x? That's just not a reasonable sort of outcome. So I think, number one, are they realistic in terms of what you can get on the asset class? Maybe you get surprised to the upside, but even long periods of time, some of the best allocators are not getting 5 to 10x on their venture portfolio. Number two, why are you doing it? Like, why do you want to implement venture as part of is it a diversification thing? Is it because you believe in the technology revolution and what it can bring? And then thirdly, what are your opportunity costs? Like, what else could you invest in? And does it make sense to implement something like that? And then from there, the team spends a lot of time just actually tailoring solutions for them of like, Earnest, for example, this is what you have in your portfolio right now. This is how, you want it to look. Here's how we would recommend you building it. Oftentimes, private investing has been done opportunistically, which is I find a deal here, I find a deal here, and then you look at a portfolio that doesn't actually make sense.
Yeah.
Because you have one vintage year, you've invested like 60% of your assets, and then you have a bunch of exposure in fintech, it really just doesn't tie together. And so, being able to understand how somebody what is their long-term goals, and sometimes their long-term goals, believe it or not, are not just based on economic return. It's like it's learning, it's impact. And so you have to take all those things of the why and then be able to deliver someone advice that helps them build it in a way that's going to meet all their economic and non-economic goals. So those are the questions we asked in the first conversation.
Are there any other things that you'd love to share with this audience as long as we've got you?
Yeah, the only other thing that I would mention is, we've been, doing this for 3 years now. We've seen the growth of the market. The market has changed a lot. So when we started, it was 2021. This is like almost the worst timing to create an organization focused on privates going into 2022 and 23. However, it is very clear that, when you build a well-diversified, balanced portfolio, not having any privates, it makes me really wonder how are you going to actually capture alpha? Because by the time these companies are going public, some of these companies are 50, 60, 100, 150 billion in market cap. And so when I think about public versus private, they're both equities at the end of the day. One is just non-tradable. The other one is tradable. But oftentimes what you see in the venture market are companies that are being funded that 25 years ago would have been public companies. Those have been IPOs. And so, the big thing is find, whether it's us, whether it's somebody else that you want to use as your engine to build your private portfolios or manage your private portfolios, make sure you do it in a way that really takes into account your own personal, care, your characteristics, and then also make sure that it's something you want to sign up for the long term. This is not a type of, asset or set of assets that you come in and out of. And I see so many people underperform dramatically on their privates because they come in and out of the market. They usually come in, unfortunately, when the times are the hottest, and then they sell off and they go through this trough of disillusionment after the bubble bursts and they miss out on the good years until things get hot again, then they go back in.
So would you say now is a good time to be investing in venture because valuations are down, but maybe in the Series A and above?
I think that the ingredients for it being a good vintage are certainly there. There are going to be areas where I think people will lose money and I don't think are going to come out. And I think a lot of these large AI deals, they're great companies that are basically building the pipelines and the infrastructure, but from an investability standpoint, probably won't ever, make the type of returns. And that's okay. Like we've seen this before. But if you were to ask me right now, sobriety's back. People have to do more with less, and that's always a good thing when you have capital constraints. So put AI out for a second. If you're a SaaS company or a consumer company, the bar is really high to raise a Series A and Series B. So companies are much further along. So it's not just the valuations, but it's more efficiency in the builds. It's less competitors doing the exact same thing because everyone was getting funded. So I do feel like the next few vintages at least have the opportunity to outperform and maybe, if done right, will make up for maybe some of the poor performance of people that invested in heavily in 2020 and 21.
Thanks, Samir. Always good to talk to you. And where should people find you if they're, family office or a GP?
Yeah, so you can go to allocate.co. That's the website. We also, as you know, I have my own podcast where I talk about venture, which is Venture Unlocked, which is Substack, iTunes, and Spotify, and my LinkedIn. If anyone has any questions.
Awesome. Well, check out Samir there.
to have
And
you.
thanks so
Thanks.
much for being on. Thanks.
Thanks, everybody.
See you later, allocator.
After Portfolio Tile, investing with a smile.